want to sell your business to a strategic? Do you want to sell your business to a financial acquirer? There's pros and cons to both, ways they tend to look at deals, things you want to contemplate. That's what we want to talk about today. I'm Arthur Petropoulos, managing partner here at Hillview Partners. We're a middle market, lower middle market, M&A and capital advisory firm, helping companies, executives, ownership of companies generating typically $1 million or so in EBITDA, up to $10 million a year in EBITDA, to sell their businesses to secure capital. And so, in the spectrum of buyers that we've talked about in many of our videos, there's going to be many different participants. On one end of the spectrum, it could be one person with a lot of money. On the other end of the spectrum, it could be a Fortune 10 company with billions and billions of dollars. However, generally speaking, there's two main categories of acquirers of businesses. You're going to have strategic acquirers. Those are effectively operating companies that do similar, adjacent things as your company. And on the other hand, it's going to be financial acquirers. And these are private equity firms, growth equity firms, family offices. There's different ways of describing them. Generally speaking, into dangerously oversimplify life, let's say there's strategic operating companies and private equity firms. Now, let's walk through four variables that are contemplated in the process of selling a business and how each one varies in their typical temperament or disposition. And then at the end of this video, I do want to highlight some nuance that's worth keeping in mind. And so the first of these is going to be capital. And so most strategic acquirers are purely going to buy acquisitions or acquire businesses with cash. With publicly traded companies, sometimes it can be stock, but typically it is all going to be something readily available. Private equity, on the other hand, in some situations, is going to require some sort of outside capital or loan. Now, certain private equity firms, and the ones we like to work with, can deploy full cash day one, and perhaps they refinance the business in some shape, form, or fashion post-transaction. However, it's something to ask about. So if you're talking to a strategic acquirer, you can almost rest assured that it's always going to be a cash deal. If you're talking to private equity, you want to ask, is the capital all there to be deployed, or is there some outside financing, approvals, investment, etc., that will be necessary? Now, second is going to be speed. And this is where the financial buyers can sometimes have the advantage. With a large corporation, they usually have a corporate development group. Sometimes they're more well-defined, but they can sometimes be thinly staffed. You'd be surprised. You could have a $100 billion company that has 20 people working on acquisitions. And so they can sometimes be overwhelmed just by virtue of the amount of volume that they're trying to process with deals. And so private equity, on the other hand, given that they are in the business of doing deals all day, can sometimes have a slightly quicker conveyor belt. So while strategics oftentimes can have a more aggressive complexion of capital in terms of saying, hey, we can just make a cash deal, they can sometimes move a little bit slower than private equity, who is chewing through deals because that is effectively the business that they function. And number three is structure. And it kind of goes back to the first point relative to the complexion of the deal. But oftentimes it's strategic. When they're buying a company, they're saying, hey, we're going to buy the company. Here's all of the capital day one. We will see at times is an earn-out in the sense of, hey, these targets need to be hit over the next 2 years to get some further upside for the business. But typically, the structure from an ownership perspective is that 100% of the company is being acquired by a strategic acquirer. Now, with a private equity firm, on the other hand, particularly in these last few years, more and more of the deals are asking for an equity roll forward. And so what that means is that an acquirer would come in and value the company for $10, and they'll pay $8 today for 80% of the business, and $2 of value will roll forward into the next iteration of ownership. And this has a lot of nuance and detail to it. However, more so with private equity, are you going to see situations where there's a post-transaction equity roll forward, if you will, from a structural perspective. And lastly is involvement, or post-transaction involvement. And so typically with the strategic, they will buy a company, and they will usually, we find, have a, call it tapering involvement for the ownership of a business. And oftentimes when someone's selling a business to a strategic acquirer, it's part of a retirement plan. And so they're saying, hey, I want to be involved for another year, another 6 months, or another 12 months, 18 months, 24 months. But usually that is a tapering involvement. It is slowly kind of winding down, getting more responsibilities into other people's hands. Whereas in private equity, you will more so see, again, kind of consistent with the structure, if there was a roll forward of the equity, oftentimes private equity is seeking for the ownership or executives of a business to continue forward with it. And many times it's because private equity does not have executives, right? If they already have a portfolio company, then perhaps they have someone running the ship, if you will. But if they're buying a business as a platform business, and for anything that's kind of $3 million in EBITDA or north, a lot of people will look at it as a platform company, then they're going to say, this is a great business, but we need the people to keep running it. And now you'd say, well, why sell it if I have to keep running it? And the reality of that is that it is going to be more involved than perhaps a sale to a strategic where you can just purely phase out of the business. However, what it does do is allow people to begin that tapering exercise, but really focus on the things they want to focus on. And so oftentimes people start businesses because they're really good at selling something, they're really good at financing something, they're really good at operating something. But then when they start running a business that gets bigger and bigger, they're doing 50 different things. Oftentimes getting the right private equity partner can allow someone to kind of recalibrate their mind and recalibrate their focus to the elements of the business that they really were obsessed with in the beginning. And that can be a very, very fruitful kind of next iteration for the company. So from that perspective, an involvement perspective, you'll oftentimes see someone sell 80% of their business, take on new employees to kind of facilitate more, and the strategic partner, the private equity firm partner, to do more of the administrative back office elements, and then focus just on sales for the next 3 to 7 years, and then sell the whole thing again at a 10x value where that 20% can be worth multiple times what the 80% was worth. And I digress and get excited, but the point is the post-transaction involvement oftentimes looks different. Private equity that has a portfolio company will resemble more of a strategic in terms of allowing ownership to potentially taper off if those are the objectives, whereas in a situation where they're buying this company as a platform, they'll want ownership of the executives to continue forward with the business. And so there's other variables that can be compared, and one thing we did not highlight is price, because in either situation, private equity or a strategic can be the more aggressive price-wise, and so that can change depending on things. However, generally speaking, if you're thinking about selling a business and you say, okay, what are really the differences between strategic acquirers and financial or private equity acquirers? Let's recap these 4 variables to keep in mind and the typical disposition of the acquirer in each of these points. The first is going to be the complexion of capital, in which case strategics are going to largely always be all cash, whereas there's sometimes financing elements to private equity firms that in financial acquirers, and that you'll want to look into. Secondly is going to be speed. While strategics can oftentimes have deep pockets and less approvals, if you will, for the deployment of capital, the speed at which they evaluate things, oftentimes because they just don't have the same kind of manpower and they're also running a company, is not going to be as fast as private equity. So something to contemplate in the exercise. 3 is going to be structure. Whereas if it's all cash, most of the time 100% of equity trades hands to strategic. There can be earnouts, components to it still, so there can be some post-transaction payment or consideration. However, usually you see 100% trading hands in terms of equity ownership of the business, whereas with a financial acquirer, we've been seeing more and more of less than 100% to keep people involved and excited to contribute to the business. And we've seen as low as 51% majority acquisitions up to 90%. Lastly is post-transaction involvement. Most of the time a strategic is going to contemplate some sort of a tapering off for the ownership of business, particularly if that owner is seeking some sort of a tapering. Whereas private equity, again, depending if they have a platform company or not, may be seeking that same kind of tapering, but in many cases is effectively seeking a horse to back, is seeking someone to, they say, hey, wait, we can really grow this thing. How do we sign this person up for the next 3 to 7 year tour of duty? And so the ultimate question we're often asked is, which is better? And the answer to that is, well, it depends. What are the objectives? So we work with every client to say, what are the objectives? What, if you had your druthers in an ideal world, what does the future ideal existence look like? Let's work backwards. Let's see who could be the optimal partner. And having the right mix of both strategics and financial acquirers also allows for more leverage in negotiating, right? If you have an all cash, slower deal from a strategic and you have a mostly cash, faster deal from private equity, well, you can go to one and say you have to move faster, or go to the other and say we need more cash, but it gives you leverage. The more participants in something makes a process more efficient, makes a market more efficient, and optimizes data points across a spectrum. So that's a thought for today. Contemplating a financial acquirer versus a strategic acquirer, what are some of the differences? Well, these are 4 main ones to think about. I hope the week continues to go well for everyone. Keep pushing forward. God bless. We'll see you next time.